Hi there, my name is Chen Hong, and I'm a senior economist of the Fiscal Affairs Department at the IMF. As you may know, our summer school series consists of video clips from online courses offered by IMF. This episode provides an overview of the course, the Audit Program, which is one of the many modules of our series called Virtual Training to Advanced Revenue Administration, or VITARA. Why is this module so important? An audit program is one of the many critical tools that a tax administration can use to increase compliance. The course is designed for participants to understand how audit contributes to compliance and key considerations in managing and resourcing an audit program. You will learn about important topics such as the importance of legislation that empowers tax administrations to make inquiries, obtain information, and reassess, impose, or waive penalties. The need for segregation of duties between auditors, case selectors, and dispute resolution personnel. The variety of audit types used by modern tax administrations based on identified compliance risks, and much more. After watching this summer school preview, we hope that you're joining us and register for the Audit Program course. A registration link is posted in the video description. Thank you.
To meet the segregation of duties rule, the audit function should be organizationally separate from the Compliance Risk Management or CRM, audit case selection, dispute resolution, and criminal investigations functions. To ensure independence, ideally, these functions should not operate within the same reporting structure. In very small tax administrations, it may not be possible that each function has its own reporting structure, but the activities should be conducted in separate teams as a minimum. To illustrate good segregation of duty through organization structure, let's look at a function-based organization structure with large taxpayer segmentation. You can see that the headquarters, or HQ, program design, and CRM activities, which include audit case selection, are primarily conducted within the Program Design and Reform Directorate, with some flexibility for local or regional case selection for a portion of the cases. The Large Taxpayer Office, or LTO, and other segments, included in regional and district offices, report to the Deputy Head Operations. For administrations that have a Criminal Investigations Division, this division would fall within the Legal and International Directorate. In some countries, the dispute resolution functions reports directly to the tax administration head rather than through the HQ function, as shown here. As you can see from the diagram, the responsibility for HQ program design is separate from the operational delivery of the audits and verification, which is in the Operations Directorate. HQ sets the strategic direction and selects cases through the CRM function. The regional offices deliver the program by conducting the audits identified by CRM and according to the strategy developed by the HQ Program Design Group. Where the volume of taxpayers and audits allows, administrations can further segregate their workloads using centers of expertise. This is where an organizational unit specializes in a certain industry or issue. Examples include high net worth individuals, the underground economy, or aggressive tax planning. In the diagram shown here, these centers of expertise would be within the regional and district offices. While this figure represents a typical model for administration to use as a starting point in their organizational design, you should make adjustments recognizing your specific country circumstances.
Because of the increasing complexity and variety of risks, Most modern tax administrations have developed an assortment of audit methods. This range from simple verification checks, such as using phone calls or emails, to more formal audits. Phone calls or emails can be used to clarify possible discrepancies and to provide assurance on the correctness of relatively minor items. Formal audits can be conducted from the desk or by visiting the business when it is necessary to delve deeper into the business records. In cases of the most serious forms of tax evasion or fraud, tax administrations use specialized experts to conduct criminal investigations. In some countries, such criminal investigations are conducted by specialized external bodies, such as the police. When considering the types of audit and verification methods, you need to ensure the following. The type of audit or verification matches the nature of the identified risk. The legislation empowers the tax administration to conduct inquiries using a variety of methods. Detailed guidelines on how compliance staff should choose the most appropriate audit type are included in manuals and other training resources. Resources are allocated in a balanced way. The ratio of the various audit types is monitored to ensure efficient coverage of identified risks. Large numbers of minor verification checks, which may contribute little to overall compliance management, are minimized. Compliance risk management, or CRM, and audit case selection teams decide on the nature of the audit type and inform the auditor accordingly. These are some of the key considerations for the types of audits and verification methods. There are two types of audit methods: direct methods and indirect methods. Direct methods are suitable for cases in which the books and records can be relied on to reflect the reality of the business operations. The audit consists of comparing the tax return with the business books and records to identify differences in facts or legislative interpretation. This is the traditional method of auditing. Indirect methods could be more appropriate where it has been determined that the books and records cannot be relied upon. For example, there are weak internal controls and/or there are many cash transactions. Sometimes it's what's not in the books and records that's important. That is, unreported income, which requires a different approach than a direct audit. It is generally recognized that indirect audit methods fall into 6 different categories: benchmarking, cross-checking, bank deposit and cash expenditure, source and application of funds, percentage markup, and unit and volume. Depending on the nature of the business and the risks identified, it may be appropriate to use a combination of different indirect audit methods. Here are some indications of the need to adopt indirect methods. The taxpayer fails to maintain records, unexplained wealth, or declared income does not reflect the taxpayer's standard of living. The income recorded in the books and records does not appear consistent with the observed business activity. The taxpayer consistently declares losses or insubstantial income for an extended period. Most business operations are in cash, documents are incomplete, record keeping is poor, and internal controls are weak. So, auditors need to be skilled in both direct and indirect auditing methods and be able to recognize which method is most appropriate for different circumstances.